Hi, my name is Silvia Escobar, and we're here with Arturo Escobar, and we're from Escobar Homes and Family. We work with Keller Williams. We are real estate agents. We're realtors. We've been doing it for a while. And what we do here is, for those of you who have come in before and watched this before, you know that we have these monthly workshops in which we invite someone who will be able to talk about a specific subject that we believe will be beneficial to our community and our clients. And so today we have Siomara Barboza, and she is a lender with Second Federal, and we are eager to hear what she has to say specifically to first-time home buyers, but also we know that there are programs that apply to all buyers, and she will be sharing about that as well as ITIN numbers. So again, this is being recorded. It will be going to different people with different needs, and we want to be able to share those opportunities today. Siomara has been working with, we've been working with Siomara for a few years. I think Arturo was calculating maybe 15 years. And so it's always good. We love recommending the people that we work with that we know have been very good to our clients. And so Siomara is one of those people. And today she will be sharing with us about all of these things that are very beneficial for first-time home buyers to know about. So Siomara, thank you for being here.
Thanks for having me. Yes, Arturo and I, and we go quite just knowing that clients are in good hands with you guys, and you've done it always full time. So I will say that I don't work for the Second Federal Savings Bank. I work for the Federal Savings Bank. So just a little correction there. But just honored to have the opportunity to speak to you guys today and just talk a little bit about the process, answer questions, and talk about, more importantly, the benefits of owning a home, which is certainly one of the pillars of wealth in the United States.
Great. Siomara, would you like me to pull up the presentation?
Absolutely. Please.
I just want to say that when we met 15 years ago, I used to have black hair, not anymore.
Thankfully, we can dye it, right?
Well, some of us have chosen to stop dyeing. So, okay, do you see it there?
Yep.
Okay.
So, as she said, Siomara from the Federal Savings Bank. This is my contact information. We certainly will provide it to everybody as well. You know, our main focus today is going to be first-time buyers. So, as we move along, you know, this is just a short presentation on, you know, am I ready? Do I, you know, what do I need to know? How do I get started? And then, you know, what do I do? So these are just some of the topics of conversation today. On to the next one, some of the benefits, you know, of buying, right? Some things that we or you as homeowners should keep in mind, right? What are the benefits to buying versus some of the benefits of not purchasing a home? So some advantages, as you'll see here, when you buy, you're building wealth, right? So in this country, there'll be another slide that I'll be able to show that you'll see that values of homes have always increased and have, you know, certainly maybe not increased as much as they have in the last 10 years, but they've always been a way to build wealth. There's a sense of community, stability, and inevitably at the end of the day, you're paying someone's mortgage, whether it's yours or your landlord's, right? Now, as far as renting, right, there is no surprises. You know, the landlord is responsible for everything versus when you own something, you are maintaining that property. So it's something to, you know, we'll get into the fact that, you know, we'll always want to make sure that you're getting into a loan that you feel comfortable with and paying on a monthly basis, because again, there are surprises, you know, there are maintenance and, you know, something may go out, the furnace may go out, and now you have to pay for that versus when you're renting, you know, all the amenities are included. So you get to call somebody. It's easy to move in, move out. There's less maintenance. But then there's other things to consider, right? You don't have that the freedom of just having your own home. You have neighbors, you have less control of what can be done with the unit. There's no benefit to renting, right? There's no write-off, whereas when you own a property, you're able to write off the interest that is paid. So as you make more money, and the more you make, the more Uncle Sam is going to take from you, right? So you want to have deductions. And aside from, maybe children having dependents, renting and paying that interest, which on a mortgage, you're paying mainly interest for the first 5 years. So that's tax deductible, which is nice. So certainly some things to consider and keep in mind. And we'll move on to the next one here. People usually ask, so what are documents that you need? So what's the process look like? So basically you're going to talk to a banker, a loan officer such as myself, and we're going to be looking at your credit report, look at what sort of expenses are needed. So I always get the question, do you need to look at my credit report? Absolutely. There is an ability to pull a soft pull. So we are just looking at your debt. If we don't want your credit to be affected, there is an ability to do a soft pull. So we're not getting the actual scores, but we're actually just obtaining the information and figuring out, okay, once you do apply, what can you qualify for? So we'll ask for your last 2 years of tax returns. It does say 2 to 3, depending on what program. So if there's a first-time buyer program, they will ask for 3 years. So 2 to 3 years of federal tax returns, 2 or 3 years of the W-2s. We'll verify your employment with your employer. We'll want to request pay stubs, bank statements to show, where the money is coming from, and as well as, any assets, and you're not necessarily to use, but to show that, you are getting into something that you can financially handle, and that there's other avenues and other savings that you have, as well as an ID. And then, life happens, right? So there is divorces that occur, child support may be needed. So we are asking these questions up front as well. Questions on, can I qualify? What will we be looking at? So again, we're looking at your credit report to see what are your expenses? What is your credit history? And we're looking to see that, you're making all your payments on time, and you haven't fallen behind on your credit card. That's only $100, right? If you're having a hard time with your credit cards or your car payment, then it's going to be even harder to pay a mortgage of $1,500, $2,500. So we're looking at your credit history. We're looking at your expenses. We're looking at your employment, that you have a history of employment, that you're not having gaps of unemployment, and that things make sense, right? We want to make sure that this is going to be something that you handle, because again, when you own a property, there is maintenance, there are unexpected surprises. So we want to make sure that your percentage of usage of your income going towards the mortgage and all your expenses is no more than 38, 45 max %, including the mortgage. And then we're looking at your down payment and discussing any sort of down payment programs that you qualify, depending on your line of work, your income, and so on. Going on to the down payment program, many people tend to believe, and it's, back 15, 20 years ago, you were required to put a full 20% down. So I do have that question. I don't have the 20% necessary to purchase. That is not the case. There is these are the 4 types of financing available that you'll see. Conventional financing being the primary one, FHA, which stands for the Federal Housing Authority, also is fantastic. VA for veterans that have served our country. They can do financing at 0%, no mortgage insurance. Great program. We are a veteran-owned bank, so we do a lot of VA financing. And then if you're in a rural area, you may look at the USDA financing as well. But all of these programs don't require 20%. VA requires no money down. It's 100% financing. FHA will require 3.5% of the purchase price as the down payment. And then conventional, there is a program with 3% depending on your income and the area which you're buying. It can be as low as 3% or as high as 5%. So 20% is not needed. Who is who? So who are you going to be dealing with during the process? That's what we're talking here or seeing here is, you're going to need an appraiser. We, the bank, will order an appraisal on that property. Essentially, we want to make sure that you're not overpaying for the property and we're not over lending on that home. It's a safeguard for both the bank and the individual to make sure that it is a fair market value. Otherwise, that's where one can renegotiate and back out of the contract without losing the earnest money that you give up front. So there will be a closing settlement agent, which is someone that works for a title company. They play as the middleman and ensure that there's no liens or expenses on that title or on that property, excuse me. And then a loan officer such as myself that basically is ensuring that, that you understand the process, that you are getting into a home that you do in fact feel comfortable spending on a monthly basis and understand what are all those costs. And then a loan servicer, we don't always service the loan. We are a federally chartered bank, so we do service some of our own business, but it's certainly not, depending on the situation, we may sell it to Chase or Wells Fargo or another institution. And then next slide, mortgage insurer. So depending on if you decide not to put a full 20% down, you have something called private mortgage insurance. So, a mortgage insurance company, which basically ensures that that if you do in fact default on the loan, there's an insurance policy that covers the bank and a portion of that loan. So in this case, Genworth is one company that we work with. You'll have a mortgage lender that depending on who you work with. So I work again with the Federal Savings Bank. Property inspector, that is going to be something that you'll notice Arturo and Silvia certainly always advise, and we always advise our clients. In Illinois, it's not, a lot of times in many states, it's not required, but it's certainly advisable, right? This is a purchase and the largest purchase that you probably will make in your life. So it is beneficial to get a home inspection and see what the life is of the cooling system, the heating system, the electrical work, the roof, and so on. So definitely it may be $300, $400, $500, but it is definitely, in my opinion, one of the best investments when you're buying a home and understanding, what you're actually buying and then being able to use that in order to, go back and renegotiate if need be, if you see that there is a large expense that needs to be addressed. And then lastly, but not least, is probably one of the most important things is the real estate agent who, you certainly want to work with someone that is experienced, that, does this full time, that cares. And, as Arturo mentioned, him and I and Silvia, we've worked with each other for quite a long time. This is certainly not our first rodeo. And, we have a good rapport with each other and understanding, you do good before people, and we have them clients for life, essentially, and enjoy just doing a good service and working with, like I said, an agent's going to know a full-time agent will understand what's going on with the community, where, understand what your needs are. And then some terms that that are important to kind of know, your amortization. So how long is this loan going to be good for? You can get a 30-year fix, you can get a 20-year, you can pay it off in 15 years. So that's what an amortization is. Your APR, a lot of times they say, always ask up front, what's the APR? So that not only you're understanding what the interest rate is, but your APR is your interest rate plus your closing cost in a percentage form. So if you're getting what right now, let's say a 6.5% rate, but then your APR is 8%, that's going to be alarming. Something's wrong, and you're getting charged a lot of money. We'll discuss the closing costs. There should be an itemization of all those expenses. We do work with the credit bureaus, the 3 credit bureaus being TransUnion, Equifax, and Experian, and whenever an institution pulls your credit, you by law do get a copy of what the scores are. So we'll always send that. You'll hear the acronym DTI, that stands for debt to income ratio. So essentially that's your gross monthly income divided into all your expenses, monthly expenses, as well as your mortgage payment, your taxes, insurance, and principal and interest. And then lastly is the equity. Basically, the equity is the portion of the property that you actually own through the making of the payments and or the down payment. So, depending on the down payment, right? If you put 5%, now you have 5% equity in the home. And then a few other ones is an escrow account. All this information I'm happy to provide. I usually provide a package to all my first-time buyers with some of these terminologies, because there's just no way that people will grasp what you're talking about just by going all this. But some very commonly heard terms: escrow, where you're putting and saving for your taxes and insurance. Gross income, we're looking when we're qualifying the consumer, we're not looking at their net income, but their gross income. Points, something that we definitely are seeing more often now is loans that there is a percentage of maybe a point or a half a point, which is essentially 0.5% of the loan amount, or 1 point would be 1%. So on a $300,000 loan amount, that 1%, which equals 1 point, would be $3,000. So that's points. Pre-qualification versus a pre-approval. Pre-qualification is essentially, we're just talking numbers. We're not looking at all your financials and pulling a credit report. We're just kind of pre-qualifying you because maybe you're going to buy in a year and you just kind of want to talk it out. Versus a pre-approval, that is what you're going to need to actually start hitting the pavement and seeing homes and making sure that you're comfortable with the payments and know what you're getting into, because we've reviewed everything. We've reviewed all your financials that we discussed earlier. And moving on, what is PITI? It basically is an acronym that stands for principal, interest, taxes, and insurance. That's what makes up the payment of a mortgage. So when you buy a home, you're going to be paying principal and interest on that money that you're borrowing. And aside from that, you're paying property taxes for purchasing on that land, and the city charges you something for that. And then as well as insurance, which is an insurance policy that would cover, if there was a natural disaster of some sort, there's an insurance policy that would help cover and rebuild that property. And moving on, and Arturo, definitely stop me if there's any questions. Anybody, please feel free to jump in and ask. Understanding your credit here, this is just a short slide on, what are we looking at? What is credit, right? We're basically, as a lender, looking to see what your ability and willingness and what your past history has been on paying your expenses and money that you've borrowed in the past. If there's any mistakes on the report, that's why we will have a conversation of, okay, here's what I see on your credit report. And by law, you are able to dispute anything that maybe you may not had known about. And that's why I normally tell people, if you're looking to purchase, don't wait till you have to move out 30, 60 days. You want to give yourself 6 months, even up to a year, before, to look at your credit report, to see if there's any errors in the credit report, because it will take some time to get things removed by law. Companies have a certain amount of time to respond to the consumer. So when you dispute something, it doesn't automatically get removed. So certainly give yourself some time. And then again, it just labels some of, the 3 credit bureaus that we are working directly with. So don't be fooled. It won't be the same scores as your Credit Karma or your Discover credit card scores that they're giving you, because they have their own specific algorithm that they're using versus Credit Karma. But Credit Karma is just giving you an idea of where you stand. And then, just to mention, you can pull your own credit report through Equifax, Experian, and TransUnion once a year for free. Once you want to see your scores, and that's when you start to pay, but you certainly can see, what's on your credit report for free. And moving on, some of the information that is found on your credit report is your personal information, all variations of how your name has been spelled, your account history, basically, what has been your history of repayment. Public records will show if you've had any bankruptcy, any judgments, any liens. So we're looking at what your public records, what information is found there, as well as your credit inquiries. Certainly, one thing that I always tell people is, if you're going to buy a home, don't go out and buy that car. Your credit will be pulled 1,000,000 times, and then you come to me and then you want to buy a home and your credit has been pulled 15 times and I'm pulling it once. So that's when you're going to start to see credit scores decrease. Moving on, understanding your FICO scores. So what are some of the factors that come into play with your credit score? We're looking again at your payment history, what you owe versus how much is being lent. So the magic number really is 30%. So essentially, in order to yield the highest credit score possible, you want to borrow no more than 30% of whatever the limit is. So on $1,000 credit card, you don't want to spend any more than about $300, or have an outstanding balance of $300. We're looking at the length of your credit history, which is why I always advise people, don't close a credit card. If you don't want to use it anymore, cut it up, throw it away, but don't close your accounts, because that really is helping your scores with the longevity, showing that you've had credit for 10, 15 years. Even if you're not using it, sometimes they'll close it on its own, but that's better to do it that way, or even just put something on it a year, because the length of your credit is a good percentage of your scores. You're looking to see if you've gotten any new credit, and then again, looking at any closed accounts, which actually decrease your scores. Best practices: limit the number of credit lines, especially when right before you buy, right? That's why I advise people, let's have you look at, anticipate, if you know what you're going to buy, 6 months, a year, let's start talking. I always give a free consultation, as well as your real estate agent, getting a feel of what the market's doing, getting an advice of what prices of homes are. It's definitely beneficial. Stay below your credit limit. Like I said, you don't want to spend any more than about 30%, or have an outstanding balance of about 30% of the limit. You want to pay things on time. I always say, it's really unfortunate when I see people have had late payments and it's only a $30 monthly payment. So, set up automatic withdrawals, so that way you're not missing any payments. Pay things on time, keep your contact information current, and then always have an emergency fund, right? It's always helpful to be able to tap into other funds if need be. And keep new credit lines at a minimum. Again, that's for the sake of, we certainly don't want to pull your credit and then you've already, opened up a couple of new credit cards, purchased a car where they're pulling your credit 5, 6 times, and then, I'm pulling your credit. Now we're seeing a decrease in scores. That's no fun. What can I afford? So this is just a quick, it's just a mathematical equation that we're looking at your gross income versus your expenses. So in this example, someone who makes $36,000 divided by 12, that's about $3,000 a month. Assuming that they don't spend any more than about 38% of their gross income, that's $1,140. And let's say in this example, there's $220 in monthly expenses. They have a couple credit cards, totals $220. That means they're left with about $920 for their mortgage payment. So one thing I tell people is we don't qualify people based on a purchase price, but rather a monthly expense. And this is an example of what we do to figure what that number is. And then the steps to choosing a home, again, know your budget. That's going to be one thing that we will discuss up front is, I can certainly give you an idea of what the bank is going to allow you to spend on a monthly basis for this home. But at the end of the day, everyone has a different lifestyle. So certainly talking about your budget, what is it that you feel comfortable spending on a monthly budget is important. There is a cost breakdown that I will share, and we can pull that up in a little bit here, that I give to consumers to give them an idea of what are all the expenses, what are the monthly payments. And if you give yourself those 6 to 12 months ahead of time, if you're living, at home or you're living with family and you're only making $500 monthly payment, you can get used to making those payments, maybe, 6 months beforehand, and at the same time start saving. So for example, if you're only making $500 monthly payments and the proposed mortgage payment is going to be 15, if you give yourself 6 months, that's going to get you used to, you can give the $500 to, your family member and then open up a separate account of $1,000, or open up a separate account, label it my future mortgage. And then now, start paying $1,500 a month. And now you're putting $1,000 in a separate account and giving the $500 to your potential landlord or family member, right? And you're getting yourself accustomed to spending $1,500, and now you have $6,000 after 6 months. So that's what I mean by certainly advisable to think ahead. And if this is a goal of yours, let's have a conversation about that. And the point is, don't get emotionally attached. We want to make sure that you look at all your finances before, Arturo takes you out and starts looking at homes. So doing your research, thinking ahead, knowing your budget before looking looking for your home is important. Next, choosing, choosing your agent. So what's important, like I said, we're here today with Silvia and Arturo. They have over 20 years of experience, full-time agents, and you want to work with someone that is, in the trenches and understanding the market and is well known in their industry, in their market, knows the areas that you're looking, and isn't just doing this part-time. So very important. I highly, recommend Arturo and his team, because for these reasons, they are going to be able to give you an idea of what's going on in their market and are familiar with, with the real estate market for many, many years. And again, this is, I work for the Federal Savings Bank, and I think it'd be nice to open it up for questions, or we can pop up the cost breakdown that I do share with everybody. I think it's important to know what you're getting into as well.
Okay, let's see if I can find that now. Okay, are there any questions while we're trying to find this? Any questions from anyone?
All right.
All right.
No questions, but like I said, it's important to always know what your expenses are and what you're getting into. So your banker should be able to give you just a one-page snapshot of, okay, here's what you're going to be spending. Here's the proposed home for, let's say, $300,000. Here's the down payment that you'd be putting down, as well as what the proposed monthly, let's say, property taxes are. And that's where, you want to work with, I work with Arturo for many years, and we work well because I'm able to say, hey, so, Isaac, what areas are you looking at buying a home? And depending on that area, he'll share with me what are the proposed taxes so that I can give something like this information here that will show, okay, on a $355,000 home, with property taxes of, let's say, $59,16, we can scroll down a little bit. It's going to tell us, okay, what are all the monthly expenses? What are the down payment? So you'll see that on the top left-hand side, this is assuming a 5% down payment. So, in this example, that's $17,750. It will list all the expenses, which is right under closing cost. If there's a point being charged, you're going to see that. What are the other costs, the appraisal, the credit report, the flood certificate that we pull to make sure the property is not in a flood zone, the third-party fees like title, and attorney fees, depending on what state you're purchasing, that will be a cost. And then to the right is going to be, the actual, how much are you borrowing and what are your monthly expenses? So we want you to know two things. You need to ask the bankers, how much are my monthly payments? So in this example, borrowing 95% of the value of the home with the principal and interest and the taxes and insurance and the PMI, because you are going to be paying PMI unless it's a unique program. Usually you're paying private mortgage insurance. In this example, it's just under $3,000. And then you need 31,000, or let's round it up to 32,000. I think that I see some questions.
Yes. So the question here is, so regarding earnest money, is it fairly easy to get back if you get outbid, or you have to cover an unforeseen expense in your personal life?
I think I can answer that one. The earnest money is given to the listing office or to their attorney, the seller's attorney, 24 hours or 72 hours after the paperwork is signed. The contract also allows for 5 days attorney review, in which those 5 days, if attorneys review and home inspection review. So if during those 5 days, let's say we do the inspection and the inspection come up with a lot of issues, legally you could say just your attorney could say, I disapprove the contract and you get your earnest money back. With no issues. The only expense that you will have to, the money that you have to invest at that point is the homeowner's inspection cost, which is about $400 to $500, depending on the size of the house. So your earnest money in the first 5 days of the contract does not have any risk. You don't have any risk of losing it. Is there a follow-up question on that, or?
No.
Okay.
If you have a question and you can put it in the chat, or you can put or you can just unmute and go ahead and ask. Siomara, are there any particular programs that you want to share for the first-time buyers, or even for anyone who wants to buy a second home? What would you say would be some of the programs that are out there right now?
Some unique programs to
Oh, Siomara, I think you're cutting off a little bit.
to lend with just 5% on a second home.
Siomara, can you back up a little bit, because you got frozen for a little bit? Can you start over on that?
Do a purchase on a and then for those investors out there that may be purchasing.
Siomara,
Yep.
can you hear me? Can you back up? Can you start from the beginning, because you froze a little bit and we were not able to hear you.
Hear me now?
You're still frozen, but
now it's good.
Yeah. Okay, here we go. Can you hear us? Hello?
down payment programs. Yep.
Okay,
There are programs for first-time buyers that one can
Hmm.
on a housing development authority that will help with the down payment and or closing cost. And then for a second home, someone that wants to buy a property, say in Michigan.
Siomara?
And then for those investors that may be out there, you can purchase with 15% on a 1 to 4 unit property. So say you want to buy a 3 unit building, you certainly can with as little as 15%. These are programs that are Fannie and Freddie.
Okay, so I think maybe you were a little choppy there, and so we didn't really get the full program. But I think what we can do is we can add it to the YouTube channel, some of the programs that you said are available. And with those of you who are attending will get a copy of this recording, and then we will also pass it over in the newsletter to people. And so we'll have that information if you can just provide that for us to put it on there. And then was there anything else, if you're thinking about, like, okay, we've covered a great deal on the PowerPoint in a very practical way. Is there anything else that you think would be important for buyers, people who are thinking about buying, or people who are are thinking about buying in the long term or thinking about in the short term? What would be your any last comments that you would have for them?
You know, I think that it would be nice to discuss and show the recession slide that we have. And certainly I know that it's a little choppy here, but we can definitely, Arturo help me out here. But there is a chart that I'd like to share with everybody here, given the
Mhm.
that direction. So there are a lot of consumers that are, you know, kind of on the fence of purchasing and thinking, well, maybe, you know, the homes are going to decrease. And, you know, this chart here will show what
So yeah, why don't we let Arturo help you out with the explanation of this.
the
Um,
recession. Go ahead.
Yeah, we'll let Arturo help you with the just kind of walking through the chart right now and see if we get less choppy as we move forward.
Yes, I love this charter because of it explains in a long period of time, since the 60s to 2020, the reaction that the market had in periods of recession. Those dark blue lines represent the years where the country went to recession. And as you can see, every year, basically steadily, the prices of the home have increased until the 2007 and 2008 recession, which was the real estate markets was hit very, very hard. And the reason, and you can see the prices going down. And then about 2014 probably started to go up again. The reason that in that period, in 2007, 2008, where it began, that the prices went down, is because there were a lot of issues, a lot of illegal things being done in the real estate market. People were able to find and to buy homes that they couldn't afford with no without any check, without any restrictions. Basically, the no DAC programs that allow people to buy homes that they couldn't afford, and a lot of illegal things were being done. So after that, a lot of regulations have happened, and the real estate market is more regulated. And you can see after the 2017, when all of that situation was clear, people were penalized, and some lenders were really had to pay big fees because they were doing things that were not right. Also, real estate attorneys and realtors were disciplined harshly in those days because they were doing things that were not allowed to, that were not supposed to do. And so, but then after clearing that, the market again went up, and we went through all of these years in which had experienced increases in values tremendous. So, and as you can see, that line steady, and it went to some very areas where the prices increased, went back a little bit, and then we went back again. So what that charter tells me is that recessions doesn't affect the prices of the houses. Even through the hard years of the economy, the prices were going up and up and up, except in that 2008, 2007 and 8, and longer years that we were doing things that we were not supposed to do. And that's why the market was affected. In other words, in those days, the problem was in the real estate. Now what we see is a problem outside real estate, pandemia, the economy. And so most of the economists, most of the experts say that the prices are not going to be decreasing. Maybe the scale that we're increasing is going to level somehow, but we're not going to be losing money in houses like we did in 2008, 2007, 2010, 12, 15, or before that.
Before that. And I would also add that even though there's a dip in those years, it is not a dip that completely decreases back to, decades. It's only a slight dip. And overall, you see a continuous rise on the in the real estate market. Siomara, would you like to add anything to that?
No, go ahead.
I like to add the fact that, so when you are if you buy your home right now with the idea of keeping your home for 5, 6, 10 years, you are going to experience those periods of increase in value. So the important thing when you purchase your home is to stay in a price range that you can afford, because
the monthly mortgage,
the mortgage monthly payment, yes, because that's what defines whether you are going to be in trouble or not. So if you stay in a mortgage payment that you can afford, you're going to have to be paying rent anyway, and eventually your house is going to increase in value, and you will benefit of living in your own home, which is an awesome feeling, and then the increase in value during those 5 to 10 years that you're going to stay there.
Siomara, anything that you would like
I'm
to
here. Nope. I think that explains it very nicely.
Okay. Okay, well, are there any questions for Siomara or for Arturo so far? Or we're actually we have about 5 more minutes, so if anyone has any questions that they can answer for you. All right. Okay, well, we saw this chart, and then you spoke about some of the programs that are out there. You did this presentation. Is there anything else that you think that you would like to end with?
Just like I said in the beginning, I firmly believe that, and through this chart, you can see that owning a home is one of, if not the greatest investment that you can make in your life. There's nothing that you can invest and get a better rate of return. So that's why I share that chart with you, so you can see, right, no matter what in history, that's always been a pillar of wealth in, especially in the middle class. So essentially, that's why we're here. We're here to empower people and to show that anybody can be a homeowner as long as you are working with people that will explain things and it's transparent, right? You go with your gut. And we're certainly here and to help. And thanks for having me today. And I feel honored and grateful to be talking with you guys, and certainly happy to answer any questions and, and have a free consultation.
Great. I know we showed your information earlier, and it was on the slide and it might have gone a little fast. Would you like to share your phone number for people to jot it down? Oh, I think we lost you again.
I'm here. Yeah, no.
Okay.
When we'll put it on there.
Okay. So then we'll include that information when everyone gets the recording. Siomara, thank you so much for being here. I will say that when we talk to Siomara, when we talk to our clients who have been working with Siomara, they say, oh, she was great. She did a great job with us. We really appreciate her. And then when we talk to Siomara, she says, oh, your clients were great. They were so nice. I loved working with them. So we make a great team, I think. And so we enjoy working with you. Thank you so much for sharing this information and being available. And of course, for those of you who joined us, thank you for being here.
Yes.
We do share this with as I said, with our clients, with newsletters. And so there's really no urgency for people to be here unless they have questions or they want to be here to see this. If those of you who asked questions, you are asking not only for yourselves, but for people who will be watching the recording and do not have the opportunity to ask. So thank you for being here. And then, of course, if you have any real estate questions, if you have any real estate needs, we are here to serve you as well. Siomara is here to serve you. And when you get the information, when you get the recording of this video, you will also get all the contact information with it. So again, thank you all. And we hope you have a good night. Thank you, Siomara.
Thank you. Good night.